Welcome to this Fund Manager interview brought to you by Livewire Markets. My name is Vishal Tekshnani, and today I have Tom Millner, Portfolio Manager at the BKI Investment Company, a listed investment company. We've had numerous requests from Livewire readers to get Tom on the show, and I'm so delighted he could join us to have a chat. Tom, welcome. How are you?
Hi, Vishal. Thanks for having me on Livewire.
Yeah, no problem at all. So, Tom, you recently published your quarterly report and you discussed the end of the longest bull market in history. You talked through the fiscal policy response that the government has committed to, and we've seen 30% falls in equity markets. So, when you kind of stack all those things up, are you seeing value emerge?
Yeah, we are. We sold a few smaller positions, Vishal, in the reporting season on an ex-dividend basis. In hindsight, that probably wasn't enough, but when the market fell 35% from the peak, we put our toe in the water, started buying a few things. However, the market's rallied quite significantly. It's up, 15-16% from the bottom. So we're back on the sidelines watching. We think there's a huge disjoint between current market prices and valuations and what we're actually seeing in the market. So we don't really know where else is going to end up yet. So we're probably back on the sidelines at the moment.
Okay, so can you kind of quantify the switches you've made? How much cash were you after reporting season? When did you decide to get back on the sideline, and how much cash are you back at again?
Yeah, so once we paid the dividend in February to BKI shareholders, we had cash of probably 3.5-4%. We lodged our NTA for March this afternoon. It shows that cash is about 7%. We think with the dividends that we're receiving the next few days, few weeks, we'll be at probably 8% cash.
Okay, and so what is it that triggered you? Is it simply what has it triggered you to increase the cash position? Was there a specific thing, or was it just this rally was too far too fast?
A bit of both. I think when you've got someone as experienced as my dad on the investment committee at BKI and Souls, you sort of listen to his comments when he sort of tells you to be patient and make sure you've got cash on the sidelines. So that's what we've done. We don't like buying uncertainty though, so we haven't really pulled the trigger on a lot of that yet. And the current economic situation is probably going to get a little bit worse, we think, before it could get better. Unemployment rate could go to 10-15% in this country. Supply chains across the globe need to be reinstated. Human behaviour might change permanently. Using Microsoft Teams and Zoom and all these programs have been an unbelievable way to access technology. But cities, airports, offices, schools across the globe, they're all closed. So we're probably going to see this for another 3 months, maybe 6, maybe 12 months. So we don't really know where we're at the moment. But what we do know is that at the GFC, we came through this, and long-term patient investors were rewarded with some pretty good opportunities.
Okay, so we'll dive into some of the things you mentioned there, but is there something that surprised you in particular about what happened in March?
Yeah, I mean, we've had a big fall, but then you've seen a big bounce from the lows. So, and the volumes that we've seen have been quite substantial. The ASX only yesterday has announced that the average daily trading was up 96%, I think, from memory, year on year. So, there's some big figures. Don't really understand the rally that we're seeing, given the fundamentals that we're also seeing in the market. But we do understand there's a lot of ETFs and index funds that need rebalancing day by day. We understand that moves in oil, iron ore, gold, for example, have had an immediate reaction on all those stocks that directly correlated to those commodities. And I think if you go back 3-6 months to the low rate environment we were in and the chase for yield, that argument does still play out. It's probably got a bit better in some instances. Rates aren't 75 basis points anymore, they're 25 basis points. Investors are searching more and more for income because they need that to live on. But even with the bank's help, the TDs are still only probably 1.6 to 1.7%. So, we can see investors going into the market looking for yield. The trouble we've now seen the last couple of weeks is dividend cancellations, deferrals. These are probably going to be ongoing for a little bit longer yet. And if you remember the GFC, a lot of companies did cut their dividend.
Oh yeah, by about 30% on average. Yeah.
Yep.
Okay. So we'll talk about dividend cuts in a moment. So one of the things that I found interesting in your recent quarterly was that you said that it's times like this when qualitative factors of your process become more valuable. Talk to investors about what are some of these qualitative factors that you're finding to be particularly important in this environment.
Yeah, sure. So we've got at Contact and at BKI and Sols across the board, we've sort of developed 5 main strategies to look at a stock in any environment. It's principal activity, income, balance sheet strength, management, and valuation. So just running through that quickly, principal activity, we need to understand how the business makes money in all economic environments. We need to know what that company's competitive advantage is. And if it doesn't have one in these environments, it gets found out pretty quickly. Step 2 is the income. We've found over the years that companies that offer a sustainable and growing dividend stream are usually, or quite often, the ones that are better quality anyway. And that only happens if you've got a strong balance sheet. So we're always wary of companies with overgeared balance sheets. We saw it in the GFC. It's playing out now. The companies with weak balance sheets have to come back to market. They dilute existing shareholders, and it's very, very unattractive to us. Step 4 is the management. We spend a lot of time on assessing the management, the board skill set. We place a lot of weight on alignment because we like to co-invest with managers. And then once we run through all that, we get to valuation. It's a very rigorous process. It's pretty disciplined, and our process is very repeatable. So we run it across all our companies. And I think at the end of the day, you've got to know what you're buying. At the moment, we don't really know what that earnings stream is for a lot of our companies. So it's leaving the valuation piece a little bit untold at the moment, unfortunately.
Yeah, it's such an unprecedented environment, right? It's like they said in the mainstream media, it's the cancelled economy. So, given it's just so hard to make any forecasts around cash flows, these unpredictable dividend suspensions, has that made your process a lot more challenging?
We've tried to keep the process as much as we can, but it's definitely been challenging. But we've got a great team at Contact. There's 9 of us. We've got a really, really good board at BKI and a good investment committee. We've got a lot of access through the Soul Pat's group of companies. So, my fellow PM, Will Colbert, and I are just trying to encourage our team to get on the phone, talk to as many people as we can. The whole market's not shut. Reece had a call yesterday. A few of us jumped in the car, went up to a few showrooms and had a talk to, the managers of those businesses to try and, get a good feel on what's happening with that business. It's difficult, but we're just trying to be as annoying as we can on the phones and trying to test as many theories as we can.
Love the persistence. Okay, so you talked about dividends earlier, and it's been unprecedented the amount of dividend suspensions and cancellations of dividends we've seen. Now, coming to your mandate at BKI, your role is to provide invest in high quality companies with a view to providing growing dividends. How these cancellations in dividends, how's that impacted your strategy, and are there any companies, I guess, which surprised you? Took the carpet away in terms of you didn't think they'd cancel dividends, and how do you deal with that?
It's a really good question, and it's an interesting one and become quite a difficult area. We've had, I think the timing of it's interesting. You've had reporting season where companies have reported a half or full year result. They've declared a dividend. Some cases they've even gone ex-dividend. So you think that dividend's completely banked, yet, the day before they pay it, they've cancelled it or deferred it. So it's been a very difficult one to watch. But, this is going to sound very obvious. As an investor, you really do need to be focused on those companies who, even in this environment, have a bulletproof business, a company who's still in operation, still producing good and real cash flows, has a strong balance sheet, as we mentioned before, not just to survive on, but to actually use that to generate cash. A company that's well managed. Situations like this make or break management teams, and that's why a good quality management team is very important. And with all that, then has the ability to continue to pay dividends. There's been a few that surprised us on the downside. I think Seek and Harvey Norman on the downside have probably disappointed us, but we understand why they've done it. But there's a lot of stocks that fit this criteria at the moment and doing well. You've got Woolies, Coles, Wesfarmers, TPG, Telstra, ASX, CBA, Ramsay, Sonic, Resources. You've got New Hope, BHP, and then Transport Lindsay, Australia. So there's probably a dozen names that we own that are still doing pretty well in this time. I think the important thing to note for LICs as well, Vishal, is the traditional guys under the company structure can smooth dividends, and we've done that before. Did it through the GFC, and talking to BKI, we've got retained earnings of about $35 million, and surplus franking credits that we can pay out to shareholders over time.
Okay. And before we come to talk about more of those companies, you mentioned that Seek and Harvey Norman disappointed a bit. How do you deal with that? Do you try and understand that this is part of the cycle and look through at the end, or do you decide that, hey, you've cut your dividend, you're out of the portfolio?
Yeah, it's an interesting question. I think as long-term managers, we do have the ability to look through the cycle and hold these companies if we, I suppose, trust management and believe that they're holding that capital back to benefit shareholders in the longer term. And with Harvey Norman management team and Seek management team, for example, we do trust them. We do believe in them. They've got a great history of creating shareholder wealth over the long term. So it's not nice that we don't receive that dividend over the short term, but longer term, by holding that capital back and making their business model stronger, it'll be beneficial for shareholders longer term.
Okay. And you mentioned bulletproof balance sheet, and you named a couple of stocks there. Investors are going to be very, very nervous about yields, and they're going to be wanting yields to be as stable as possible, and preferably growing, of course. Can you talk through maybe 2 to 3 names that you have utmost confidence in that they'll hold or even increase their dividends as we go through the cycle?
Yeah, there's a couple. I think what we've seen with the stay-at-home strategy is that people are obviously having to eat at home and not in cafes and restaurants as we've become accustomed to. Companies like Coles and Woolworths in particular, they'll produce some pretty good results, we think, for the 6 months. The do-it-yourself market is very well suited to Wesfarmers and their business, Bunnings. The strain on data, TPG and Telstra, we think their business model's going to be underpinned by the next 6 months. And I think, from a banking point of view, CBA is far superior to a lot of the other banks in the marketplace. They're very well capitalised. They've been, I suppose, preparing themselves for a situation like this, and APRA has done a very good job in making the banks hold a lot of excess capital over the last few years. So we're very confident in CBA's position as well going forward.
Okay. All right. Thanks for that, Tom. A last question I'll finish off with is, what are the reasons for optimism? And what are the markers you look for a turnaround? You've got that 7% cash weighting. What would make you be fully invested again?
I think what we're looking at is some global benchmarks, if you like. We're looking pretty closely at South Korea. We're looking pretty closely at Italy. They were the first countries that went through this virus crisis to start with. So we're looking to see how quickly they come out of that and how well they manage it. Once we do that, we'll obviously have to start looking in our own backyard, and there's a lot of companies that have been hit quite significantly through these shutdowns. But you know, we'll get through this. We've got through this before. There's been many crises worldwide before that we've got through. And then I think what you see then is a reset in society. Many companies will become, you know, fit for purpose. They'll have better, stronger balance sheets. They'll have a more experienced management team that will ultimately lead to a better business, and they'll be able to survive the next sort of 8 or 10 year cycle, whatever it happens to be. But I suppose while we wait for that, we accumulate cash and wait for the position, because, you know, like most opportunities, that, you know, the fortunate investor is the most patient and the one that can look longer term. So we've got that ability at BKI, and the team at Contact are really looking forward, I suppose, to the next 6 or 12 months, whatever it ends up being. So I think there'll be some once in a lifetime opportunities out of this for long-term investors.
Fantastic, Tom. That sounds really great. Just got to get to the end of it all, I guess.
Yeah.
Anything else you wanted to add?
No, I just, you know, I think, you know, I think from a public point of view, everyone's been great. It's reset everyone's expectations. You know, I think the fact that we're not all getting up at 5:30, 6 a.m. and you know, rushing on public transport to get to work has been quite beneficial from a mindset point of view from a lot of people. So hopefully we can take that into the next 6 or 12 months and make a clear path of better investment opportunities.
I couldn't agree with that more, Tom. All right, thank you so much on behalf of the Livewire team and our subscribers for your time today. Really appreciate it.
Thanks for having us. Cheers.